Gold markets continue to explode to the upside, and this is a market that has become increasingly dangerous day by day. And I've never seen a market go straight up in the air that didn't have some type of vicious crash. The trick, of course, is trying to figure out when that crash is. So if we do continue lower from here, I think 1.14 could be targeted. And then the 200-day EMA, if we break down below there, the bottom's going to fall out. The Nasdaq 100 continues to climb as we are now at 25,100 and moving to the upside. You can see Bitcoin continues to recover as it looks like we are heading toward the $125,000 level. And if we can break above the recent highs at about $126,000, then I think we just continue the overall uptrend. This is Coach Chris Lewis from Hola Prime with your technical wrap-up. The Wednesday session has been very good to both silver and gold. You can see that silver finds itself above the $49 level, and this is an area that I think you need to be cognizant of. This is an area that in the past has been the top two other times, going back to 1979. So the question is, can we break above here? I do think it's possible, but I also recognize that there is a lot of history here, and there is going to be a lot of fear. I suspect that if we do get a reasonable sell-off, people may be quicker to sell silver than maybe gold. That doesn't mean we can't go higher. It just means that you're probably looking for a bit of a pullback in order to find value. When you look at the hourly chart, $48 could be support, so could $48.50. So finding a little bit of value at the very least is probably how you want to approach this market. Gold markets continue to explode to the upside, and this is a market that has become increasingly dangerous day by day. And I've never seen a market go straight up in the air that didn't have some type of vicious crash. The trick, of course, is trying to figure out when that crash is. Right now, I don't think we're showing any real signs of it, but I also am hesitant to just chase. There are far too many other markets out there that you can trade and mitigate your risks in a much easier way. The $4,000 level would be the most obvious area of interest, I think. And on the hourly chart, you can clearly see it is an area that the 50-hour EMA is actually tracking to. So maybe we'll just wait and see. This is a very strong uptrend, but we are starting to see some noise during the session late, specifically as America's on board. So it'll be interesting to see if that continues. That being said, take a look at the euro. I know everybody is out there talking about US dollar is going to implode, and that's why gold's going higher, except for most people have forgotten to tell the US dollar this. So we are testing the 1.16 level. It's an area that I think if we break through here, then we get serious traction to the downside. What I cannot help but notice is that during the FOMC interest rate decision and meeting, the euro really took off because everybody was counting on a couple of interest rate cuts from the Federal Reserve being dollar negative. And that can be the case. But the question is, are they starting to see cracks in the economy? Cracks in the U.S. economy are very rarely, and by very rarely, I mean never, contained within the United States. We go through this every couple of years, where the argument that the US dollar won't be the world's reserve currency much longer starts being thrown around. The US dollar is going to zero. Gold is exploding because central banks are getting away from US debt. On and on. I hear this about every 2 to 3 years, and typically that's when the US dollar starts to strengthen. It turns out that's exactly what's happening right now. So if we do continue lower from here, I think 1.14 could be targeted. And then the 200-day EMA, if we break down below there, the bottom's going to fall out. This is not a healthy looking market, and it needs to turn around right now or things could get ugly. The British pound finds itself selling off during the session as well, and I think you've got a situation where, although the pound itself isn't necessarily horribly weak, the reality is that the US dollar is gaining momentum, and that is going to punish the British pound as a result. It's not necessarily a scenario where I think shorting the pound is the easiest trade. But what I do look at this chart as is a tertiary indicator. If the British pound really starts to roll over against the US dollar, that means the US dollar probably strengthens against almost everything. The 1.32 level is the bottom of the recent consolidation area, and I think we need to pay close attention to it. We are going to try to get there from everything I see on this chart, but I recognize that the 1.33 level is currently where the 200-day EMA is parked. Really, at this point, I don't have as much interest in shorting the pound as I do the euro, but what I will do is watch this, because if this starts to take off to the downside, that means other currencies like the euro and the Canadian dollar are probably being punished pretty thoroughly by the greenback. So sometimes you need to step outside of the pairs you're trading to get a little bit better barometer. And for me, the British pound is an excellent one because it had outperformed so many other currencies for so long. Even on the way down, it lost less than others. The US dollar has rallied against the Swiss franc, and this might be a sleeper trade. At this point, I got long earlier, willing to take the risk of a trendline break during the session. But more importantly, we broke above the 0.80 level. We're also above the 50-day EMA, and now I think the next major barrier is going to be found at the 0.81 level. Remember that there is a positive swap at the end of every day for this currency pair, and as a result, you need to pay attention to what it is the swap is going to gain you. If you can get a somewhat sideways market that drifts higher, that's actually the best case scenario, because as time goes on and you have stability, you're also getting paid at the end of every day. If you can hang on to that trade for several weeks, the next thing you know, it doesn't take much to get a risk-free trade. I don't know that we're about to see that, but it is a strategy that I plan on testing. If we can break that 0.81 level, it would not surprise me at all to see the US dollar turn things around at an extremely low level. Historically speaking, this has been major support, so we'll have to see if that ends up being the case again. The US dollar continues to scream to the upside against the Japanese yen, and this is a market that's going to be very difficult to chase. Quite frankly, this is one of the hardest things to do in trading, is to watch a move like this and recognize that the risk just isn't worth it. This is something that I think comes in time and with experience, because you see enough of these moves and you realize that the minute you press the buy button, you're going to find that the market corrects 400 pips. Something called Murphy's Law. So I'm basically waiting for the Japanese yen to strengthen a little bit in order to get long. There are other currencies that you can play against the Japanese yen, obviously, but this is clearly a Japanese yen situation that's exacerbated by the fact that the US dollar is so strong. The 151 yen level is an area that could offer support, followed by the 149 yen level, and then, of course, the gap, which is all the way down at the 148 yen level. If you were to take a position now, you'd be looking at something close to a 500 pip stop loss if you're going to cover all of your bases. Simply put, unless you're aiming for 162 yen at the minimum, there's no way to take that trade. What you'll need to do is see a pullback and then a bounce, and then you can have some type of reference point in which to mitigate your risk. The US dollar has turned around against the Canadian dollar during the trading session after initially falling on Wednesday, as we find ourselves dancing around between the 1.39 level on the bottom and the 1.40 level on the top. This is a particularly interesting currency pair for me, mainly due to the fact that The trade war still rages, and of course, the US dollar continues to strengthen. Canada finds itself in a very difficult position at the moment because, quite frankly, the Canadian economy is very weak, and its largest trading partner is currently in the middle of a big spat with it. If the Canadians were to stop exporting to the United States, it would wipe out almost 30% of their total GDP. In other words, they are far too dependent on the United States to think that anything will change quickly. This would be a massive turnaround in things if Canada can break free. So at this point, as I watch employment numbers get worse in Canada, I prefer to get long of this market. Keep in mind that the last employment number was a loss of 65,000 jobs, and this Friday we get more Canadian employment numbers. If the U.S. government opens up, then we'll also get U.S. numbers that should have been here last week. Ultimately, the U.S. economy seems to be still relatively strong, and if that's going to be the case, it does make a lot of sense that we continue to go higher. If we get another negative Canadian dollar related employment number, that could send this pair towards the 1.4250 level, as the Bank of Canada will find itself under a lot of pressure to loosen monetary policy even further. The Australian dollar initially fell against the US dollar, but it has found the familiar 0.6550 level as support as we have turned around to form a bit of a hammer. It's probably also worth noting that the 50-day EMA sits right there as well, so it makes a certain amount of sense that value hunting has come into the picture. Turn around and rally from here, and then you'll find this pair testing the 0.6633 level. Anything above that opens up 0.67 or so. That being said, the Australian dollar has a long history of underperforming, and I know that it has risen against the US dollar, but when you compare this chart with the British pound or even the euro, it's a bit lackluster after the initial bounce. This action here is very difficult to think of in anything other than short-term types of trades, which is fine if that's what you're looking to do. If we break down below the 0.6550 level, it could open up a move down to the 200-day EMA, which is currently at the 0.65 level. I don't have any real interest in, quite frankly, putting a lot of money into this market. I think we're more or less stuck in a sideways market right around where we are now. The Australian dollar has just lived in its own world for a while. I think that probably continues. The euro initially fell against the British pound during trading here on Wednesday, piercing the 50-day EMA, but bounced a bit to show signs of hesitation. This is interesting because it looks like we are trying to form some type of hammer after forming an inverted hammer during the previous session. Typically, when you see this, what this means is we're about to enter some type of sideways consolidation. This pair is absolutely notorious for doing that, so it would not surprise me at all, especially as the 50-day EMA is sitting right here. If we do break down, the 0.86 level is your next major support level, but on the upside, the 0.8750 level is a major resistance barrier that has already shown itself to be reliable 3 different times this year. A look at the moving average convergence divergence indicator, or MACD, shows that we do in fact have divergence. So I think I still favor the downside, although I think it's going to be more of a drift lower. Again, this is a choppy pair under the best of circumstances, so that would not surprise me. The euro fell rather hard during the trading session against the Swiss franc, but has found support right around the 0.9250 level, an area that has been support more than once, as we have been bouncing around for some time. The euro against the Swiss franc is an interesting barometer of risk appetite, but it's not the most volatile pair under normal circumstances. It's choppy, sure, but it tends to be choppy in short ranges, meaning that unless you are a short-term trader, there really isn't a whole lot to do with this pair. But it can give you an idea as to how risk appetite is flowing, and it is worth noting that the Swiss franc seems to be struggling a little bit during the day, so that suggests that people are willing to take on a little bit of risk. If we do rally from here, the 0.9350 level is an area of potential resistance, and if we can break above there, the 0.9450 level would be your next target. On the downside, if we break down below the 0.9250 level, then it's possible that the euro could go looking to the 0.92 level, but that would be in a very risk-off type of environment as traders run back to the Swiss franc for safety. All things being equal, I don't really see much changing in this pair, but this is one that you have to watch over the longer term to see if there are sudden shifts in the way traders are behaving globally. As things stand right now, I don't really see it. I think we remain very noisy in this pair as there is a lot of uncertainty out there and, quite frankly, confusion. Earlier, I talked about the US dollar against the Japanese yen, and you can see that the euro is showing a little bit more hesitation than the dollar was. And this, of course, makes sense because the euro is falling against the US dollar. So why would it have the same type of gains against the yen as the greenback? This could lead to a bit of a pullback, and I think you've got a situation where these other currencies, like the euro, might actually lead the way for the Japanese yen to recover a bit because, quite frankly, this is all based on speculation that the new president will become the new prime minister who will push for loose monetary policy. At the end of the day, the Japanese are going to have loose monetary policy regardless of what happens. And I think this explosive move to the upside is overdone, at least for the short term. Longer term, I think we go much higher in all of the yen-denominated pairs, regardless of the currency. But I think we've got a situation here where we are starting to see a little bit of hesitancy, and that's exactly what you need to see in order to eventually fall enough to find some type of value. This market could drop all the way back down to the 173 yen level, and as long as we bounced from there, not much will have changed. It would still be a bullish market. On the other hand, if we can turn around and break above the 178 yen level, then we could go to the 180 yen level. But again, I don't like chasing these yen-related trades. I've spent the last 3 days just sitting here and waiting. And if you are patient enough, you should get paid for a longer-term swing trade that could last weeks, possibly even months. The British pound has rallied nicely against the Swiss franc, but did struggle at the 50-day EMA. The 50-day EMA currently sits right around the 1.0775 level and is dropping. The 50-day EMA has also served as a nice downtrend line as of late. So I think you've got a scenario where traders are looking at this through the prism of whether or not we can break this technical barrier. If and when we do, then it opens up a move to the 1.09 level, possibly even 1.0950, where you would start to talk about challenging the 200-day EMA in that environment. In the pound-Swiss pair, we have a massive support level between 1.0650 and 1.06. If, for some reason, that were breached, that would be an extraordinarily huge sign of risk appetite being crushed. The Swiss franc is a safety currency. The British pound, although not a risky currency, is considered further out on the risk spectrum than Switzerland, and therefore it would tell you everything you needed to know that people are running to Switzerland for safety. I do expect that we are going to continue to see a lot of volatility, and at this point I am looking to buy this pair, but it's obviously going to be very noisy. You get paid at the end of every day to hold this pair to the long side, so keep that in mind. Perhaps you can build up a position and get paid during the same time in order to pad your position waiting for it to go higher. Whether or not the Swiss National Bank goes into negative rates will continue to be questioned because they've done it before. And if they do, then we'll really see this market potentially take off. In another Japanese yen related pair, we have the British pound. You can see that we pierced the 205 yen level, but have fallen pretty significantly, and in fact have lost about 100 pips late in the day. This is a market that's tired and overstretched. This is also a market I'll be watching very closely because I want to get long of this market, but I need to see a reasonable pullback. So far, we're not anywhere close to that. This could be a situation in not only this pair, but the yen related pairs overall, where we spend the rest of the week just waiting around to get that setup that we need. We may or may not get it. We'll just have to wait and see. Regardless, I want to see a fall and then a bounce that I can start trading into. Chasing this market is a fool's errand, and unfortunately, I know a lot of retail traders are probably doing just that. Some are probably panicking already that they're down 100 pips. Shorting this market is just as reckless, if not even more so. You may find yourself in serious trouble trying to play the fill the gap trade, which I know a lot of traders will do, because you might be waiting for a while. Furthermore, you are probably, in most cases, almost certainly paying swap to do it. So even if you get the trade that you're looking for, by the time it gets down to the area that you think it's going to get, you may end up losing money anyways. So be cautious with that. The Canadian dollar has rallied quite nicely against the Swiss franc, although it has not broken out. I will say this, as weak as the Canadian dollar is, if the Canadian dollar breaks above the 50-day EMA against the Swiss franc, I will look at that as a screaming signal that the Swiss franc is going to start falling apart, and it will in fact have a lot of problems. If that happens, then I would look for a move to the 0.59 level. As things stand right now, I think this is a pair that you are looking to fade signs of exhaustion and take advantage of cheap Swiss francs. Although I'm not a big fan of the Swiss franc, it's just that I like the Canadian dollar even less. A move below the 0.57 level signifies that we just continue this overall long-term trend. The Canadian dollar is shooting straight up in the air against the Japanese yen. And with the little bit of Canadian dollar positivity that we had seen during the day, I suppose it's not a huge surprise. But we are getting to a point where we're getting ridiculously overstretched. The 110 yen level almost certainly will be a major barrier, and I think it'll be difficult to simply slice through. Again, you find yourself in a situation where you have to wait for value. You just don't have it here, where you have to have basically a 350 or maybe even 400 pip stop loss. It's just not the market for you if you're not already in it. That's fine. If you're a little bit patient, you should find a nice setup at lower levels. The euro continues to grind lower overall, and that's going to be the same here against the Norwegian krone. The Norwegian kroner breaking to the downside with the euro falling, I think opens up the possibility of the euro moving down to the 11.40 NOK level. The market rallying at this point, I think, still invites selling pressure, especially near the 50-day EMA and the 11.75 level. The euro against the Swedish krona looks a little bit positive for the session, and that tells you the divergence that we are seeing in Scandinavia, because quite frankly, the euro looks like it's in trouble. So if the Swedish krona cannot handle pressure from the euro, that'll be very interesting. That being said, there has been a lot of buying early in the day and then giving it up in this pair. So I'm still inclined to short this market at the first signs of exhaustion. The 10.85 level could be support. The 11.10 level above could be resistance, but right now it looks like we're just rounding to the downside, forming an H pattern. The New Zealand dollar fell pretty hard against the Japanese yen, only to turn around and show signs of strength. I think at this point, you can't chase this one either, but if we break above 89 yen, you may just have to. I still think you get an opportunity to buy currencies against the Japanese yen at better prices, But again, the question is, can you sit on your hands long enough? That's where the money's made sometimes. It's just simply waiting for a better price. Unfortunately, this is still the same scenario here. The New Zealand dollar against the US dollar remains pretty interesting, as we have fallen pretty significantly, but then turned around to show signs of life at the 0.5750 level. By turning the way we have to the upside, it does suggest that there's at least a little bit of support down here, but I do think given enough time, we probably fall. A little bit of sideways action between 0.5750 and 0.5850 probably makes sense, but I still fade rallies that show signs of exhaustion in a market that, quite frankly, doesn't, I think at least, have any business being this high. So we'll have to wait and see how this plays out. But again, I think this is a situation where the US dollar continues to really outshine most other currencies. Speaking of the New Zealand dollar, you can see that we fell early against the Swiss franc, only to turn around and show signs of life and form a little bit of a double bottom near the 0.46 level. Rallies at this point, again, I think, just like against the US dollar, have to be looked at with suspicion. I think it's probably only a matter of time before you see signs of exhaustion that you can start shorting. If we were to turn around and break down below the 0.4550 level, we continue to go much lower at that point. The US dollar has been both bullish and bearish against the Mexican peso during the session, as we continue to trade in the same 0.3 Mexican peso range, with 18.5 on the top and 18.2 on the bottom. With this, I think you have to look at the market as one that is just fade the rally in a downtrend, and likely to continue to be so, because if the U.S. economy is strong, so is the Mexican economy. And the U.S. economy seems to be fairly strong. The U.S. oil market, or light sweet crude, has broken above the $62 level to show signs of strength. But at this point, I still think you have a lot of overhead due to the lack of demand potentially being a problem, and of course the massive amount of supply that has come back into the markets. The 50-day EMA, which currently sits right around the $63.25 level, is probably your next major barrier. So if we do rally at this point and show signs of exhaustion, I think you have to look at that as a potential shorting opportunity. I don't really want to get aggressive with this market, but short-term traders will continue to take advantage of the overall malaise that we have seen. The Dow Jones, the NASDAQ 100 continues to climb, as we are now at 25,100 and moving to the upside. At this point, I think you've got a market that is just simply going to continue to rally, and it's difficult to short this market. When you look at the hourly chart, you can see how the day's gone. We've just taken off to the upside, and that's a sign that we're ready to continue. Reaching an all-time high during the session, of course, does wonders for confidence, and we continue to look bullish. The S&P 500 looks like it is ready to break out to the upside, and I think it's probably only a matter of time before it does exactly that, as we continue to test the all-time highs and have seen every short-term pullback bought into over the last several sessions. Will that continue to be the case as we go into Power Hour? I don't know, but I'm certainly not betting against this market at this point in time. The Dow Jones 30 is a little bit of an outlier because the day has been fairly neutral. When you look at shorter time frames, like the hourly chart, you can see that we're just kind of stuck in this range. Nonetheless, if the NASDAQ 100 and the S&P 500 continue to rally from here, that should drag the Dow Jones 30 right along with it. After all, the indices do tend to follow each other given enough time, and I think you've got a situation where that very well could be the case here as well. I certainly don't want to short any of the U.S. indices, but definitely the Dow Jones 30, despite the fact that, yes, okay, fine, maybe it's a little bit weaker than the others, I don't think that warrants shorting it. I think you're just looking at a situation where you have to understand that the markets are looking very choppy and sideways and perhaps trying to work off some of the excess froth. But really, at this point, you've got a situation where any dip is more likely than not going to end up being a buying opportunity. And finally, you can see Bitcoin continues to recover as it looks like we are heading toward the $125,000 level. And if we can break above the recent highs at about $126,000, then I think we just continue the overall uptrend. We haven't made a bullish flag yet, but we are in the process of doing so. As things stand right now, Bitcoin is still a buy on the dip market, and I have no interest whatsoever in shorting it, as it has shown itself to be extraordinarily resilient, despite the fact that, if you think about it, there's a lot of chaos at the moment, which is counterintuitive for how Bitcoin should, at least in theory, be behaving.
Hola Prime, trade with transparency.